Welcome back to the FintechOS Evolv Podcast. We're going to be talking about one of the most dynamic and underserved segments of UK banking, which is SME lending. So I'm delighted today to welcome a good friend of mine, Tim Bogue, who's the CEO of Momenta Finance. Been around a long time, NatWest and other banks, but you're stepping into those shoes now to fulfill those needs of those SMEs. So let's start by talking a little bit about Momenta Finance.
Yeah, well, it's good to be here. Thanks for the invitation, Mark. So I've been at Momenta for 7 months now. Momenta's actually been around for quite a while, for about 12 years. And it is, over that period, tried to serve SMEs, so lending to smaller businesses and to property entrepreneurs as well. Yeah. And that's what we're continuing to do. But clearly, we have ambition to grow. It's a very interesting time. As you pointed out, the market's evolved quite a lot over the last... Certainly since the global financial crisis and with COVID as well, we've seen some changes in borrowing behaviours. So with sort of 60% of the market now served by specialist lenders, we see that as a great opportunity. It's a huge amount, and it's flipped from the other way around, 60-40 just, 5-6 years ago. So there's definitely a role for specialist lenders, and it's quite an exciting time to be in the market.
You think you've been around a few, maybe a decade or so more than me, but we've been around a few decades now, and I think you've probably hit the nail on the head there. The pendulum has swung. I mean, back in our days at NatWest, specialist finance were such a small portion of that lending. And have you noticed that change now with, I said in the opening gambit, some of the traditional banks pulling back in the SME world, which has opened up this space for Momenta Finance and other providers like yourself? Why has that happened in the last 20 or so years? You mentioned COVID, you mentioned a few other things, but why are people turning to specialist finance?
I think there's a couple of things that have happened. I mean, firstly, when you get a big event like the financial crisis, for example, then banks have to review their strategies. Certainly coming out of that period, capital was very expensive, and there was new regulation, rightly so, in the sector. So banks had to think about how they allocated that capital. They had to think about their cost base. Making that more efficient, streamlining. So I think we start to see a trend of, call it digital, or moving away from that physical presence. And we saw it with branches, but even for businesses, a lot of businesses used to bank in branches, go in, see the traditional bank manager or their advisor and have a conversation.
My dad was one of them back in the day.
I mean, and you just can't do that as easily now. And that's taken place over a period of time. So there's been a bit of a gap for that, what I call the human element or the human touch, where you can go and talk to somebody about what you're thinking. I think we've got to remember as well, as a lot of small businesses, raising finance, they're not finance experts. They're there to run their business, whatever it is, make something, sell something, create something. So the finance can be a necessary requirement for that, but it's also something which they're not necessarily well steeped in. So they want someone to help them with that. So that's why you've seen the brokers coming in, the intermediaries. When I was at NatWest coming out of the crisis, we pulled away from a lot of brokers because we thought that they were giving us bad business. The reality is that those brokers now are sort of doing a very important role in ensuring that SMEs can access finance, whether it's in big banks or small banks. And the big guys are coming back into the broker community and are starting now to, have broker departments and coverage strategies for brokers and sponsoring big events. As we know, NACFB, HSBC and others are kind of coming into that market. So
do you see them wrestling it back a little bit?
A little bit, yeah. I mean, I think there's definitely more of a presence than there was, when I was at Aldermore, for example, we were sort of tier 3 going on tier 2 bank. So we didn't have a branch network, so we relied on introducers across pretty much all of our products. Some relationships direct, but mostly introducers. Whereas the big banks still had that direct channel, because you've got 25-30% market share if you're NatWest, let's say, of the SME market. You've got an incumbent population, so you're always going to have a look at most things. But I think they realised that the pendulum started to swing a little bit, and they can't afford to be out of 60% of the lending market, so they're coming back in. But they're doing it on quite a, as we'll have discussed in the past, I think they're quite digital in their approach, and they're going for sort of more volume plays. So if you fit the mould, that's great. You get what you want.
Get that a lot.
If you don't, or you're slightly outside the box and you want something a bit different, I think the big banks are still quite slow. And it takes time, and often when you're a small business, you want the money, right? So
I say they've lost 20% of their market share since 2012. That's a massive shift.
Yeah, it's big, isn't it?
I mean, it's crazy. And And okay, they're starting to fight back a little bit, but that challenger market space, the number of banking licenses has been thrown out, and the number of banks has popped up over the last 10 years or so. He's just saturated that somewhat. I do wonder if they can start to win it back, or as you say, how many customers now fall into that I'm slightly different category and need a slightly more bespoke solution rather than the kind of one size fits all that a lot of the traditional banks offer. Yeah,
and I think once you get above a certain level or a specific requirement, then it becomes harder. So we know the banks have got lots of great products, whether it's invoice finance or asset finance.
Yeah.
The good old overdraft has disappeared.
They've
got heavy capital costs, and so. When I was banking back in the day, when I started out, everybody had an overdraft.
I still think of the golden rule of thumb when trying to approve it. Was it 10% of turnover, 20% of trade debtors from memory? Was the standard rule of thumb. I wouldn't know how to possibly analyse an overdraft usage now. They're almost like a dirty word, overdrafts.
Well, it's just, if you're a customer, it's great. If you get one of those, they're like gold dust.
Don't let go of it.
Yeah, and it's so easy to use. Yeah. But if you're a bank, it's more difficult to monitor and to regulate, and you have to hold a bit more capital and so on. So that's why you've got these other products that have come to the fore. But, if you're an SME, you don't necessarily want to have a big factoring arrangement or invoice finance arrangement. You just want your 100,000 or your 200,000. So I think that's why we've seen the business loan market expand quite rapidly as part of that 60%.
Yeah, I think one of the challenges that the SMEs tend to have now, also with whether it's especially the larger banks, maybe not so much yourselves, but the ability to actually get approved. The approval rates have gone down, unsurprisingly, given the economic downturn and other things. So even from pre-financial crisis days, it's gone down like 6-7% since 2018. So that's a lot of people not being approved for whether it's an overdraft or a loan. And it's that analogy of the umbrella being taken away. So there's this why banks and maybe especially finance struggling to approve the type of business loans, overdraft facilities that SMEs need. Is it the state of the economy? Is it the appetite of the bank in general? It's good news for the likes of yourselves because you're mopping that kind of stuff up.
Yeah. I think if you look at COVID, the big banks, did put a lot of money out, supported by the British Business Bank and the government. Those government schemes, a lot of money flowed out, so they grew their balance sheets pretty quickly.
Yeah.
And I think when you've grown your balance sheet that quickly, you kind of want to take stock of it, and you don't necessarily want to be chasing everything else on top.
Yeah.
So I think there was a little bit of that going on.
Yeah.
That sort of worked its way through the system now. So that's diluted, and that's maybe why you're seeing bigger banks being a little bit more proactive.
Yeah.
So I think that's been one factor. But approval rates probably went up and were probably pretty high.
Yeah.
We've seen them dip a little bit. I think that we see a lot of good businesses, and we see a lot of businesses that I would say, good turnover, good length of trading, profitable, good directors, and they're the sort of businesses we love to work with as well.
And the demand's there, right?
And the demand's there, and you sort of think, well, why aren't you getting it from your high street bank? Because these businesses, that's their main, they still bank with all the big banks, main current accounts and so forth. So, and I think some of it is speed, and some of it doesn't quite fit the mould, or they can't get access to the right person.
Yeah.
But we also see some quite weak propositions, either because they're poorly presented, or you've got HMRC arrangements, and you sort of think, well, actually, are they overtrading a little bit? Most of what we decide not to support is on affordability. So we want to make sure that ideally the customer can afford to repay what they borrow, which is good for everybody. But there's a lot of good businesses out there.
Yeah, I do have sympathy for banks and lenders in that when you're trying to build a model, a affordability model, you need good data that sits behind it. You need consistent data that sits behind it. And I think we're 5, maybe 6 years out of COVID, and actually that's probably the period of time you want to be able to train that model to come up with some good SME-based affordability. And I think a lot of prior shops that I've worked at use commercial corporate models which are just not befitting for SME businesses. And so a lot of the deals at bigger banks will fall out of bed based on probably the wrong model or the wrong data that's gone into that model. But we are now, say, 5, 6 years. So my intuition is that these models will be a lot more accurate now, which might bleed into people getting the approval rates further up. maybe sort of some of the bigger banks stepping back into the fray. Maybe that's a reason why now that they've got the fundamentals right to be able to support that card rate, because it is a volume game. But you mentioned something earlier before around the brokers being a fundamental part, which I completely agree there is. And I guess that's why people turn to brokers, because they're afraid they're going to get declined, or they don't quite even know who to go to that's best befitting their needs. And that broker has their eye on the landscape and the horizon, and can actually start to pigeonhole them and point them to the right people, to Momenta Finance, and say, actually, for your set of circumstances, for your set of criteria, for your set of eligibility, Momenta Finance is a really good fit, and I'll introduce you, and your guys will have a good relationship with that broker network, and move on from there.
Absolutely. And we were with I was up with one of the biggest brokers in the UK yesterday. Spent the day with them, and that's the message that they give to us actually at Momenta. Look, we really want to work with you. You're an important part of our panel, and your proposition needs to be clear. And I think so. There's business that we'll write, and there's some business that we won't write. So. If we get the wrong sort of deal comes in, so for example, we tend to be a bit of a term lender. We tend to deal with established businesses. And sometimes you might get a brand new business, or you might get a business that actually wants a very short-term working capital requirement, which doesn't quite fit our model. But there are others out there who will do that. So if you're a broker, you're spoiled for choice at the moment, because you've got all these potential funders, but you have an important role to find the right 2 or 3 maybe that will be right for the borrower because of what their borrowing requirement is. And that's where I think they do a good job. Generally, they try and find the right sort of group of funders. And from my perspective, so part of my strategy is that we have a very clear proposition into the brokers, and we build good relationships, deeper relationships with a core set of introducers who really understand what we're going to do, what we're not going to do. That means that they're not disappointed if they send the wrong thing, but more importantly, if they send something to us, they know they've got a 70-80% chance plus of getting it approved, because we're on the same wavelength. But they know also they can go somewhere else if the customer has a different requirement, or a different need, or even a different credit profile, because the reality is that not all customers are the same, and they have different strengths and otherwise in terms of their credit profiles.
I was going to ask, how do you win with those brokers? Because you say they've got access to the market.
They've
got access to a lot more than just Momenta Finance and big banks. So how do you engage with those brokers to how do you enhance their experience? Say, actually, come to us. You're going to get, I'm putting words in your mouth, you're going to get a quicker decision, you're going to get for a more bespoke service. How do you win?
There's a number of things. I mean, my view, so for Momenta, my approach, or what I'm trying to do, is to blend some things you mentioned early on. So blend technology with that human element. So, relationships are really important. So the relationship we have with our introducers is really important. So we have to spend time with them. We go and see them, we spend a day in their offices, 2 or 3 of us, and certainly my sales and underwriters as well will go out, and they'll spend some time.
That's really important.
It is, and I'd like to do more of that, but they actually do deals. So yesterday we did some business because we were there, and we could crack a few deals on there and say, right, this one's in your work in progress list. Can we talk about it? And bing, 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 quick call to the customer, it's done, right? And then you're into sort of, okay, well, let's pay it out. So I think building relationships and getting to know people is really important. But in terms of how you win, that's one part of it. But of course, you've got to be responsive. So speed is really important, especially at the lower end. And that's where I think technology and decisioning comes in. But of course, it's important across the whole process. So I think ease of access. So if an introducer's coming to us, submit something, can we deal with it quickly? Can we try and get it through the system quickly? So there's a bit of two-way there, because we need what we need to do the deal.
And I agree. I think with SMEs, you think maybe a bit generalistic. They're not massively financially savvy. They haven't got the support of a finance director. They haven't got a finance department around them, and actually, sometimes they don't know they need the money until that hits the fan. So it's that day they need to pay the salary, they need to pay that wage, they need to pay that supplier off. So actually, the ability to engage really quickly, have that speed of decision and certainty of decision.
Certainty and confidence that it's going to get through. And so I think what we've seen is the market has been able to put, whether it's AI or auto decisioning models, into that sort of smaller end, probably sub 100K. And then for a business like ours, and reinvest the time of our underwriters and our sales guys in helping to shape the bigger deals, which are actually a bit more difficult to put through a model. You can put elements of that through a model, but usually you need somebody at the end of it to say, okay, this bit needs some judgment and some shaping. So, the responsiveness is really important, but so is the flexibility when you get into those sorts of deals. So I'm trying to blend a bit of both.
Yeah, the ability to actually, for an underwriter, the access to the underwriter, and the underwriters actually coming out and seeing clients and building a relationship with brokers, I think that's really powerful.
Yeah. And it's hard to do when you've got a small team and they're in the office and you've got deal flow, because you want to be responsive. But it's worth it. It's definitely worth having a good plan around, building key relationships and involving the team in that.
Yeah. So you're starting to blend a little bit with technology and people. Let's pick on the technology bit for a second then. So how are you starting to? You're doing a lot more than dipping your toe in it. But what kind of technology are you starting to look at, and how are you embedding that into the business?
So we're relatively young, so we've got our sort of core infrastructure is fine. It's cloud based, and we don't have the legacy of some of the bigger lenders. So we've got a platform there that we can work with. I think but we have had, we've grown up from a manual process, and
we all did,
and we were very little. My colleagues will tell me, the stories of Momenta ups and downs over the years, and when you actually start going out, meeting the customer, doing a loan, then coming back and then going out and seeing the next customer and doing a loan. So very to where we are now, where actually we've still got some of those strengths of that heritage and that process. But if specifically, where a broker submits a proposal for us, we're using an AI agent at the moment, testing, that first sort of package that comes to us, if you like. Does it have everything that we need to actually process it, or do we need to go back to the broker with something, and we can use an agent to help us identify that and prepare a response. I've also noticed, as we've increased our volumes recently, that we have a sort of pre-screening process for our underwriters. So before it gets to them, we've got we've got a few decision engines, but one of them looks at some basic financial information, calculates ratios, and if it's above a certain threshold, then we'll spend time on it. So that's something that had quite a lot of manual input. So we've got an agent looking at that now, and we should be going live.
That's some good efficiency drives, though. That is.
But that frees up. So that frees up, a person who was doing that, and three people when it gets really busy to actually do some underwriting or some sales. I
like it because it's targeted. So you've actually looked at your process and gone, where are people spending a lot of time that doesn't really add that much value? And rather than having a wider AI strategy, you're saying, actually, no, let's solve a couple of these things, and I guess test the elements of technology and AI. And you can track it, and you can trace it, and you can put some KPIs around it, and actually see if it's delivering. And ultimately, you've picked 2 or 3 efficiency cases that are quite easy to measure. You can see the success of them.
Yeah, we can do. So we've done some analysis on that. Time and motion stuff, relatively straightforward. And there's a lot of nervousness around technology and AI, and people go, "Well, is my job going?" I'm not doing it to cut cost. I'm doing it to actually become more efficient, helping to scale the business. And the people I've got, I'm happy with. That can do other things that will help them grow and become, whatever they want to be in their career with Momenta. So I see it as a win-win. But there's a lot more we can do on that.
So I've got some stats here about Momenta, so keep me honest. And hopefully they're right. So it says that Momenta has sold over 2,500 SMEs since you started in 2013, which is a crazy amount of customers, by the way, and dispersed over £250 million worth of finance, which is fantastic. But I think not too long ago you announced probably about another fund that you've tapped into.
So we so part of our sort of makeup is that we want to be, have the agility, if you like, of a small lender or a small business, but have the backing of institutional support. And I think the team, to be fair, before my arrival, did a fantastic job of sourcing good backers to fund our book. And there's some big names in there, and they've been very, very supportive of us. So we're grateful for that. And that allows us to do what we do at the front end, with customers. So, but we have recently raised 125 million, and the good thing about that, it's not just the quantum, it's the fact that it's priced at the premium end of SME.
Yeah.
So we can start lending at 7% all in, roughly.
Yeah.
It's linked to SONIA, roughly 7% all in for the top SME credits. And we go through our usual range up to about 22. So we've got a tiered approach to our pricing, and naturally that's linked to the credit quality of the borrower. So, we're looking at profitable businesses, been around for a while, decent size at that premium end. But it just gives us that relevance, I think, more relevant for introducers because we can serve more of the market, and more relevant for borrowers because we can attract more of the right borrowers. So that's something that we launched at the end of January, and we're continuing to.
How's it over the last few months? How's it been tapped into?
It's been tapped into. There's a lot of interest in it.
Yeah.
I think there's a lot of competition as well for those. Everybody wants to bank those businesses.
Mm-hmm.
And I think those businesses have options. So what we find is that, back to the earlier point, if an SME needs the money by a certain date, then it goes. I think with what we've seen with the geopolitical situation, there's a little bit of, okay, do I need it now? Mm-hmm. Or can I get the approval and maybe draw it later?
Sure, yeah.
And just see what happens. The other side of that coin is that, interest rates might go up. So if you get it now, get it now. Yeah. So it depends what your philosophy is as a borrower, really. So, but we've had good traction on it, a lot of interest in it, and I think that's going to be a good addition to our
real estate professionals can tap into that fund as well.
Not so much real estate. Real estate, we fund those through a different source.
Yep.
So again, we've got institutional backing for those. But we, as you know, Mark, because we've worked together on real estate deals and SME deals. It's a different borrower profile.
Yeah.
So, for example, for SMEs, business loans, typically we're lending medium to long term. So 3, 4, 5 years plus. We'll go up to 6 years on most of our core offerings. Whereas the real estate market, where we found the niche or the gap from the bigger lenders is in that shorter term market. So bridging, refurb. Stabilisation finance, something's come out of development. It needs a little bit of a while to settle down, especially if it's a trading asset like a hotel or something like that. So we see opportunities there, but often they're structured differently and priced differently because the risk profile is different. They're very bespoke. So that's a lot more hands-on. So using technology, there are opportunities, but it's a different process. And I think if you try and force it through a volume business loan type process,
it's very structured.
You're kind of going to come a cropper. So
it goes back to your point about those type of deals. They come out. They are very nuanced. They're very bespoke, and actually the ability to sit down across a desk from somebody who's experienced financier, who understands the market, has been in development finance and bridging finance all their life, and can find a structure that's befitting of your needs. You can't ask a computer to do that.
No.
You can't quite ask AI to do that just yet, but
there's elements you can improve to make the process.
The hidden talent of the banker.
Just a bit smoother, but we like to go out and see the asset, make sure it's there.
Make sure it's there.
I mean, it's first principles, isn't it? Does it actually exist?
I can remember, this is a terrible story, but a previous shop of mine that they ended up getting caught out because a couple of rogue bankers were manipulating the valuation report.
Really?
Yeah, and so they before you'd send it in PDF format, people were sending it in Word format. You think, oh my God, it's crazy looking back at it. And so a couple of road bankers were going in there and
tweaking it,
adding a few zeros to the value of the property and hiking up the loan and taking the odd commission.
We've seen a number of things in that sector recently, haven't we? With one or two high-profile failings, potential frauds, and that makes funders nervous. But there's opportunity comes out of that. I think if you've got a good business model and you've got a good discipline in the business, and the funders, trust you, you can do well. So, but it's a market which I think it's a local market. You need to know your market. You need to know the asset. Yeah. You need to have people on the ground who you trust, who can give you an honest view on the valuation and the exits sort of strategy. So, but it's good to have that. It's good to have a couple of different products because it gives us some diversity in our portfolio. And it gives us the opportunity to sort of
it's a massive growth
broaden
engine.
out both actually.
Massive growth engine. And I guess it boils down to, you said it earlier on, around that kind of institutional support and backbone of Momenta, because not only yourself gone over there, who's you are a lifetime banker, we say, very traditional background. But you've got Chris come over from Barclays as well. So you mentioned before, like the success of business predates you, obviously, but it sounds to me like feels to me that you've, because of the type of people you're bringing in, I know you've brought somebody in across real estate as well to really professionalise that outfit as well. You really are taking it seriously. You really are getting yourself ready for that push into growth.
Yeah, absolutely, yeah. And we'd like to do that. And, naturally our investors are keen for us to grow the business. We're getting some traction.
Yeah,
so we've had a good step up the last 3 months. Chris is great. He knows the SME sector really well. He used to run it at Barclays.
Yes.
And I think just having a blend of experience in the team is fantastic. We've got some people who've been there 10 years who really understand the business, hugely invested in it. We've got some younger, fresh blood come in, great new energy, new ideas.
We need it.
We've got,
how old we're feeling.
It's really exciting, to bring in, a couple of graduates and people who maybe get in their first role, for example.
Yeah.
And we all sit in the same office and we all mix together, and that's nice. But I think the experience that someone like Chris will bring, and one or two others, is that we can pick the phone up to an introducer and have and either talk about a deal or even a customer if it helps, and it just gets it across the line. Or building relationships, we can go out and have a conversation, because we've often met in the past or worked in similar institutions, and that network is. Finance and banking is a big industry, but actually you'd be surprised if you've been in it for a while. The network's fantastic.
Amazing. It literally, just as I walked in the studio today, there's a couple of people I worked with who literally bumped into me. They've sat in the seat you're sitting in. So it's amazing how it's the same names and faces that come. Even us, though, we've been around a while, we've known each other a while, and then you kind of fall out. You fall out of distance for a while, then you come back again. It's very. What's the word I'm looking for? I want to say incestuous. As an industry, it's the same people. Those networks of people is so important.
Yeah, but it's a big industry. So the people who introduced me into this role.
Is it a big step though from you go a tier one at RBS NatWest, and then you go to Aldermore, and then you go to a specialist finance like Momenta? As an individual, to make those steps into those different kind of bands of, how did you find that? Is it different to go from even from an Aldermore to a Momenta? It's a.
I think we go an Aldermore an RBS to an Aldermore, for example. The two things that you don't have as much of is, one, there's no current account, so you don't have a regular day-to-day kind of engagement with your customer, and secondly, because a lot of it's introducer base, your introducer certainly though owns the customer. That's an interesting concept coming from a big bank that will want to hold that relationship.
They have
direct relationship with the customer. So that was a big learning for me in terms of, how do you make that work, and how do you adapt the way you style and the way you operate to be successful. But then Momenta, Momenta's obviously much smaller than Aldermore, and there are different things in there. We're a small team, so we don't have everything in the team that we need to grow. We're dealing with a different segment of the market. We have to move really fast. But that's part of the upside, actually.
We've got the agility to do that.
Agility, and we can make decisions. And what we find is, I was talking to someone earlier on today about potential technology partners or AI partners, is that when you're working with a big organisation, it can take a while to get traction, because the decision with a small organisation, we can get in a room, have a conversation, agree to do something, and then on Tuesday,
make it happen.
We're going to have a go at it and try it out. So you can test and learn. Quite quickly. So we've got, even though we're smaller than the big guys, there are some attractive features that make it really exciting. And the people are great, and they I think in the main everybody there is pretty happy, and we've got a good team spirit, which you can have again with a smaller organisation.
And as you started to deploy certain technologies, you find that one of your weaknesses around scalability, you start to chip away at that, because technology gives you the ability to scale a bit quicker. Because you're filling those gaps of efficiency with technology, it frees up your people to go and do more business, which is something that they have divisions of people, like hundreds of people doing things. And I think one of the impacts of AI and technology is going to be is that actually it's good for the little guy, right? Because you got the tools to be able to go and compete.
Well, absolutely, and we can move quickly to sort of mobilise around those if we want to, and try some things. You can sort of get your head around a lot of things, but there's pros and cons in any role. But it's been quite an energising role. going into a smaller
What
group.
what's your learning? If you look back, was it 9 months you've been there? Is it 9 months?
Seven months. Yeah.
What are a couple of 2 or 3 things that you've gone, I just had no concept of that, or that's changed my view of this over those past 7 months?
I think technology actually. Maybe I was living in a dim and distant past.
Yeah,
I was thinking, we can build relationships here. But actually, when you're in what is effectively a high volume business, you need to have good technology to scale.
Yeah.
So we've grown, but we're growing by, working hard, trying to work smart. But we need that ability to scale on top of it.
Yeah.
We grow sensibly. We care about credit.
Of course.
The business got a fantastic credit record, and we've seen plenty of businesses blow up when people get overexcited and try and do too much too soon. So we want the growth, we want good credit, but we want to be able to scale. So we've got a good team in place. I'm keen to get some payback on that team and prove to the shareholders that we can deliver and get some growth in the business. And then I know they'll back us to go again.
Yeah.
So that's what we're trying to do. But I don't know if there's 2 or 3 things. I think the positives are you're working with a very, broad
They're
range,
a good bunch.
diverse,
I've met a few of them.
diverse group of people,
it's a good
different
team.
ages and experience. And,
Yeah.
when you're in a big bank, you're kind of in your peer group and you're a certain layer or whatever, and you don't really get to day to really work with people across the whole organisation.
I've gone for. I've done the kind of big bank to medium bank to small bank, and I think what it does is it exposes you to a lot more than you ever would if you're still working at a tier 1. Suddenly you are exposed to different divisions. You're involved in a lot more decisions. You're involved in product and proposition and go to market, which is also outside of your box of a if he's working in a traditional bank. So actually that just bleeds into gaining more experience and knowledge, and made me a far better banker and person, and give me the experience to go on and work with technology companies and things like that. Because if I was still, we talked earlier about NatWest being lifers. If I was still NatWest, there's no way I'd have been exposed to that type of thing. And it's going to be the same for you when you go to. So maybe you wouldn't be involved in even at Albright. You probably wouldn't. You'd be a stakeholder in technology decisions, but you wouldn't have been driving it.
That's to run hard at Aldermore to keep the business topped up and keep going.
Yeah.
But you've got to run hard every day. Where we are now.
Yeah.
There's no time to relax and admire your successes too much.
What do you think? I mean, see, you're serving real estate and SME now. Which is the bigger growth? Do you see?
In terms of number of customers, it's definitely SME because the loans typically are smaller and they're higher volume.
Yeah.
And even though there are differences, that it's an unsecured business loan up to $500,000. That's what we do at the moment.
Yeah.
I'd like over time to move up. I think there is a gap, and there are 1 or 2 people who've had some success in this gap in the past. But ThinCats and Shawbrook and so on. But I think they're now quite big. It's quite a big entity now. They're together. Yeah. I think there is a gap in up to the 5 and even possibly the 10 million for businesses in terms of lending.
Wow.
So I think the banks will serve some of that.
Yeah.
But, so I think there's an opportunity potentially for us if we want to get them all right
value
first
curve, really.
and go up the value curve.
Yeah.
And there's different skills required to do that and to do it well.
Kind of get into kind of corporate structure, corporate finance.
Yeah, you get a bit more event-driven.
Yeah.
Bit more event-driven stuff. So maybe someone buying or selling a business, or a big investment, something structural, which means there's a capital injection required.
Management buy-in, management buyouts.
Possibly, yeah. But those are the sorts of things that usually trigger trigger some sort of financing requirement. So I think that again, what often happens is that people go into these areas because they're underserved and they grow and grow and grow and they get bigger and bigger, and then they leave behind their bread and butter.
Of course, yeah.
So I think there's an opportunity. On the property side, undoubtedly that's a huge market, very competitive. Yeah. Lots of funders out there. We're not going to compete with the banks who've got deposit bases because we have a different type of transaction. There's usually a bit more structure in it. There might be a bit more risk in it. Yeah. So it's important that we analyse that. We have the skills to do it.
Okay. Well, look, I always try to end the podcast on a future-looking lens. I was trying to think as you was talking, where am I going to go with this with you? But I was thinking maybe I'm going to make it Momenta Finance centric first.
Yeah.
And say if you could I mean, you've only been there 7 months. If we could say that you've been there 3 years, what does a successful Momenta Finance look like in 3 years' time?
Goodness me. Well, I think what I'd like to do is build a business which is attractive. So we don't have a defined exit plan. Mm-hmm. So our investors have owned the business for a number of years. But I know that their ambition and my ambition is to create something that's attractive for investors. Yep. So people might want to buy us or invest in us. Something that's attractive for our partners. So whether it's our institutional funders, whether it's our introducers, and ultimately the borrower as well. Something attractive for them. They want to work with us.
Yep.
And of course for colleagues, for people who want to work with us and stay working with us.
What would be the 2 or 3 things you'd need between now and then to deliver that?
Well, I think we've got some people, so we have sort of brought some capability in. That's good. I think that needs to, now we need to get the payback from that. Being perfectly candid, 6 months is too short. But over the next 2 to 3 years, we'll get that. I mentioned technology, so we need to accelerate our plans on all elements of whether it's technology and or AI, and build the right foundations.
There's no getting away from it. Yeah.
There's no, but with our foundations have got to be solid. They're not bad. Yeah. We've got to build it on solid foundations.
I'm so glad you said that, because it frustrates me sometimes with people just lead into AI enablement, but don't recognise that actually they need to probably do a bit of housekeeping first.
Yeah. So absolutely. So good foundations, but I call it technology, but you know what I mean. That ability to scale the business. Growth through the people that we've brought in and blending those 2 things, and keeping our good backers that have supported us so far.
And I'm going to ask you one more question, which is probably more market leading, which is, how do you see, we've been around a long time, we've seen a hell of a lot of change, and the pace of change is only getting quicker and quicker and quicker. So if you could fast forward 3 years, just the state of the banking industry, how do you foresee that changing in the next 3 years? Maybe 3 to 5 years.
Well, I don't work in a big bank anymore, so I might be a little bit out of touch. What I do see is partnerships. Yeah. So I see big and small partnering. We see that in finance. We've seen Barclays doing it, Santander doing it, NatWest having innovation centres.
Yes.
So there's a lot more awareness around what smaller businesses can bring to bigger businesses to help them advance their propositions. So I think that's good. Technology, who knows? I think we can see elements of AI gobbling up what we thought a year or 2 ago was great stride forward in technology. It's becoming outdated and infrastructure like that. So I think there'll be a lot more agility. On the people front, I don't know. I think you still need good culture, and you need good people to set the tone and to lead the way. And it'd be interesting to see, just how the kind of perfect model between using all those things I just talked about, being customer centric, using whether it's AI or other forms of technology and people, how it all blends together. But I think it's going to change quite a bit. So
you're seeing some in NatWest and HSBC Barclays are doing it, and I think I can remember just the arrogance around some of the bigger banks when I was there, around not wanting to work with smaller competitors or partners, to the detriment of their customers, really. But actually that attitude has massively changed now. And I'd love the partnership answer. I think that's really, really, really important.
I think you've got to do. I mean, you go back to relationships again. This is the human piece, right, for us. I think that's where we can be really good. And we're good at it with our investors and our backers. We need to be good at it with our introducers. And when we talk to customers, we need to be good at it there. I think that's the bit that, people still talk to people. We don't want to be...
People still buy people.
We don't want to be 100%, nothing wrong with being 100% fully digitalised, automated fintech.
Yeah.
That's not where we come from in terms of our background and our heritage, but we need some of that.
Yeah.
But ultimately, I think people can be a differentiator still.
Kind of human in the loop.
Yeah, absolutely. And that's where the partnerships come in, because you can't build good partnerships unless you can build a relationship with somebody.
Where can people find out more about Momenta Finance?
I'd say two places. I mean, one is LinkedIn. Look us up on LinkedIn. All our details are on there, and we post regularly. And second thing, if you Google us, Momenta Finance, you'll come up to our website, and there's a phone number on there, or you can email us. And we'll
and brokers out there, they can register with you. They can become new relationships.
Brokers are out. They can build new relationships. We've, I think, many of them know us. But they can get in touch with us, and we'll definitely have a conversation with them.
Fantastic.
See if we can do something.
Tim, thanks for your time today. Hope you enjoyed coming on the show.
Thank you, Mark. It's a pleasure.
We'll get you back some point. It'll be fun. I really appreciate you coming on and sharing your insights around the market, and sharing insights about Momenta and what the type of problems you're trying to solve for SMEs. As I said at the top of the show, it's incredibly important. So, I'd love to have you here, and we'll hope to have you back at some point.
That's great.
Thank you very much.
Thanks for having me. Great stuff. Thanks,
Cheers,
Mark.
Tim.
Cheers.